Hello everyone, welcome back. I hope you had a good week and study and you did the homeworks that you're supposed to do, assignments, complete assignment. We are in the process of grading them. Now we're getting into chapter 2 and 3 for this week. Start with chapter 2, looking at accounting process. Well, we're going to look at transactions. Look at the transactions from beginning to end. How are we going to record a transaction and the financial statements, the books and records. Okay, let's see what we have here. Economic events. That's what we call the basic model. Cost changes in financial position of the company. What does that mean? Suppose you make a sale. When you make a sale, what really happening? You transferring product or services to another person and you get money for providing that services or product. You make a profit, you changing your financial position. Okay, that's what it simply means. External events and we have internal events. External events involve an exchange transaction with another entity. You're selling goods to a third party. That's an external event. Then when you have internal event, you do not involve an exchange transaction with another party, but within the entity. You're moving something to another, the divisions or whatnot. Okay. Accounting equation is very, very important. I'm pretty sure you all know. I think I mentioned that already from Financial Accounting 101 and 102. Accounting equations. We start all these accounting transactions. Keep this equation in mind. What does that mean? Assets always equals the liabilities plus owner's equity, shareholders' equity. Now we know we're going to look at some of these in detail with the numbers, so it's easy to understand. So what do we have here? This says underlie the process used to capture the effect of economic events. We have resources. You can see the resources here, economic resources, right? Assets are our resources. We utilize the assets, the machineries, the buildings, the office facilities, whatnot, the factories, to make a product. That's our resources. And of course, what is the other resources? The people. People are assets. But you're going to notice that we do not record people in our balance sheet. Okay, that's the human resources. It's one of the very important asset in a corporation. Okay, now that assets, it should equal to what we owe to third parties, the liabilities, plus the owners. When you get to a corporation, you as an owner, you put a capital, you put an investments into the business. That's your ownership. Okay, that's what owner's equity means. We'll get into equity part a little later, how that break down to different sections, different parts. Okay, that's what we call claims. Claims by third parties and claims by owners. You might ask, what do you mean by claims by owners? Now, when it comes to a corporation, we assume that is a legal entity by itself. Owners simply putting the investments into the business. Okay, entity by itself is a separate legal entity. So that's why the entity is supposed to pay the owners. That's what it means. Okay. Now it says each event has a dual effect. The accounting transaction, the accounting equation, one goes up, the other supposed to goes up as well. You go both sides, asset side and the liability side. should balance. If the asset goes up, sometimes you should the same amount assets supposed to go down to make it even, equal, right? Or the asset goes up, the liability is supposed to goes up as well, or vice versa. Okay, that's what it means. Okay, we'll get into some numbers again, so you'll see how that works. Here's the numbers. We're going to build this transactions all the way to the end, then you will understand better how the accounting equation works. On investments, so the attorney invested 50,000 to open a law firm, law office. So what is now? This is the starting point. He decided, okay, I'm going to open an office, my own business, my own practice. So he put 50,000 to business. That's the starting point. 50,000. Now what is an asset here? Cash. You put money into the business. Now what is the liability? What's the other side? Other sides, that's the investments by the owner. That's his investment. Suppose he'll say he decides, nah, that's not going to work. I need my money back. By tomorrow he decides, he changed his mind. So what does that mean? This is the entity supposed to give his money back. That's what it means, the owner's equity. Okay, now you understand better how that works. You put the money, and here is the capital. Okay, an investment by owner causes both assets and owner's equity to increase at the same time. Let's go to the next one. It says borrowing money from the bank. Now, he put $50,000. It might not be sufficient enough to start the business. Then he decided to borrow money from a bank. And a note payable was signed. So what happens here? Again, asset gets increased, the cash. You borrow money, right? You get money, 40,000 extra. And then increases the liability payable. You have to pay to the bank. That's the third party. It's nothing to do with owner's equity, correct? So it is a borrowing. It's a creditor. The liabilities is increases. Everybody understand that, right? This transaction causes assets and liabilities to increase at the same time, at the same amount. Okay, a bank loan increases cash and create an obligation to repay. Okay, let's go to the next one. Supplies costing 3,000 were purchased on account. Now what happens when you say on account, which means we don't pay money. We buy the supplies paying later, or promise to pay later. That's what we mean by on account. The supplies costing 3,000 were purchased on account. What's going to happen to the accounting equation? Again, the assets increases. Now remember, the supplies is not an inventory. Supplies just to use in the office building. Okay, the paper, pens, and all kind of stuff. They spend $3,000. At the same time, remember, the supplies, you're not going to use everything at once. You buy $3,000 worth of supplies, you might use it for maybe months or years. So that's why we're putting it into asset. That's like prepaid kind of thing, right? We get into that later. Supplies, 3,000. And at the same time, liabilities increases by the same amount because you didn't pay now. You're going to pay in a month or 2 months from now. That's why accounts payable has increased by the same amount. What if he paid cash? What's going to happen? Now you will see asset sides on one, supplies increases by 3. But if he paid in cash, his cash going to decrease by 3,000. So it has nothing to do with, it didn't do anything to this side, the right side of the equation, but left side, assets, one increases, the other one decreases, but it's going to still has the same balance, correct? Okay. Now you can see services were performed on account for 10,000. Now he starts doing his work for clients, right? So when he starts billing the people, what's going to happen? Now again this says on account. He did not get the cash. Nobody paid yet. So what is an account receivable? Remember, that's an asset. You create an asset when you perform or provide services until you get the cash, your income. So what happens here? The services revenue, since this is the balance sheet, we increases the owner's equity. It increases his claims equity. Okay, that's the revenue side. Okay. The next transactions here. The salaries of 5,000 were paid to employees. Now where that's going to get recorded? What's happening in the balance sheet? Of course, when we pay salaries, usually we record the salaries expense and cash. Right? When it comes to balance sheet, where is going to reside? Assets decreases by the amount, correct? Assets decreases by 5,000. We're paying 5,000 to employees, and at the same time, what is going to happen? That's an expense. Expense reduces owner's equity. Income increases the owner's equity. Then expense reduces the owner's equity. Okay. Expenses are losses. Describe outflow of assets, increases liabilities, causing owner's equity to decrease. Okay. We have another item here. What happens here? This is another transactions. $500 worth of supplies were used during the month. Sales during the month here. Now what we did when we acquire those supplies, we debit supplies account and credit accounts payables or whatnot. Now we are using those supplies. Since we debited an asset account, now we got to take it out, right? Supplies account, you reduce the supplies account by 500, and again same time you reduces equity, owner's equity, by the same amount. Again, this is an expense. Expense reduces equity. You might have a question. You might ask, what exactly? How? Why we reducing owner's equity? Now, when we get into detail, what consists of owner's equity, you're going to see why. Okay, let me tell you that. Let me just give you, before we get into much. Owner's equity consists of a couple of things. Your original capital, right? Capital account, capital, whatever amount that you put in, plus something called, now they term it paid in capital. Sometimes paid in capital, sometimes paid in capital. There's two different, paid in capital, and then you have paid in capital in excess of farm. Okay, and then the main important thing is retained earnings. Retained earnings is part of this owner's equity. What is retained earnings? Retained earnings is what you retain in the business, what earnings that you make after paying dividend to shareholders, what is left in the business, what you retain in the business. That's what retained earning is. So retained earnings, since retained earning is the profit that you keep in the business, profit, whether what's going to happen when you have an income, profit increases. When you have expense, profit decreases. So that's what's going to happen here. Expense decreases the profit, thereby decreases your retained earnings. Now, what's going to happen? Overall, owner's equity is decreases. We dump everything in one place. Owner's equity. Okay. So now you understand why we increases owner's equity when we have income, why we decreases owner's equity when we have an expenses. Okay. Payment on account. Now remember, we purchased the supplies on account. We didn't pay at the time when we buy it. So we had to pay. That's the accounts payable. That's liability side. We increase when we purchase supplies. We increases the liabilities, and we increase the liabilities. At the same time, we increase assets. Now, what's going to happen? You're going to pay those supplies. Assets going to decrease. Whatever the amount, $1,000. Cash paying 1,000. Cash reduces by that amount, and accounts payable also reduces by the same amount. Okay. Now have a $9,000 balance. Remember, we purchased a $10,000 worth of supplies. Now we have a $9,000. We pay $1,000. Okay. Here, for corporation, just looking at simply, we did discuss this already, but I'm just going to run through this. Here's what we have: assets. We know what they are, and the liabilities. We know what they are. Liabilities that we owe to suppliers, vendors, or third parties. Okay, the banks, whatever it is, the loans, accounts payable, all kind of stuff. And then we do have shareholders' equity. That's the part that you might have a little confusion in understanding. Let's see, what do we have here? Shareholders' equity consists of, as I said, paid-in capital and retained earnings. Paid-in capital, retained. Paid-in capital is what you put in the business, investments. Retained earnings, as I said, here, retained earnings, revenues, gains, minus the expenses and losses, minus the dividends gives me retained earnings. Let me put some numbers. You get a revenue is, say, 100. Gains, you have another. What do you mean gains? Gains when you sell assets, you gain. Okay, that's not necessarily something you do on a day-to-day basis. Okay, that's a gain or losses based on whether you sell assets or whatnot. So you got 100, say 20. That's 120 minus total expenses. Suppose you will say, I don't know, $60 or something, 120. Now you got a $60 left, and you pay $20 dividend. Now you got a $40 left over for that year. So that gets added to the retained earning. That's what the retained earning for this year, and we may have some retained earnings from prior years. You keep accumulating it, you keep adding, but sometimes you call accumulated retained earnings. Okay. T account introductions. It's a simple way to record the transactions. Account title at the top, the two sides for recording increases and decreases. Sometimes you have asset account, sometimes you have a liability account. Depending on that asset, we get into that details. Debit. Debit represents the left side. Here is the debit side. Okay, debit. And we have a credit side. Depending on the type of account, credit, you may have a credit balance or you may have a debit balance. What type of accounts we have? That's a very, very important thing. People sometimes get confused, don't understand, okay, this transactions, where does it go? The debit or credit? It's a very important to understand. If you miss that, you might not be able to understand well the transactions. Okay, you might record incorrectly. So that's very, very important thing to remember. If you have a transaction, if you have a balance, where does the balance supposed to go? Okay, that's depending on whether it's an asset, whether it's a liability, whether it's equity or whatnot. We'll get into that in a minute. Here we go. In these slides, we talk about assets and a liability. You can see, usually in asset account, we always has a debit balance. Debit balance increases the assets. Credit balance, when you credit that account, it decreases the assets, right? If you sell asset, you have a sales, you have machinery or whatnot, that's an asset. You have inventory, that's an asset, right? You have a cash, that's an asset. The cash, when you pay cash, cash reduces. So you credit cash to show that asset has decreased. So same token, the liabilities always has a credit balance. See, liabilities, the revenues, equities always has a credit balance. Assets, expenses, all this has a debit balance. Okay, those things you have to remember. Now, when we reduce the liability, suppose you have accounts payable. Accounts payable balance is a credit balance. When you make a payment on that accounts payable, it decreases. Okay, that's you debit that account. We're putting that the transactions in a T account and show how that works. 40,000 was borrowed from a bank and a note payable was issued. So we said this is a T account, cash account, we debit. We receive cash increases. And at the same time, what happens? So liability increases. So it's a credit. Remember, the liability always credit, asset always debit. So when you put money, when you get cash, it increases assets. We are getting into too much in this explaining what these items are, but you can take a look what we have here. Accounting equation, debit and credit, increases and decreases. Assets, debit increases, credit decreases. The liabilities is the other way. Okay. And how about shareholders' equity? Shareholders' equity is the paid-in capital, is always the credit balance increases. When you sell stocks, it increases the credit balance. Retained earnings, the same thing. When you make a profit, increases the credit balance. Okay, the retained earnings has expenses and revenues and gains. Remember, expenses debit, revenues credit. Okay, those things is very important to remember. Very important. Just some of these you can see because of my picture, but you get the picture here. General ledger. General ledger serve as control accounts. Subsidiary accounts maintained in a separate subsidiary ledgers, for example, individual accounts payable. Now, what is that? I'm pretty sure you already know. General accounts like the T accounts that we just showed. Now, subsidiary accounts. Now, in accounts, suppose let's say you have accounts payable. Accounts payable, right? A T account. It's a number, one number. Accounts payable is a big number here. So the subsidiary ledger does is break this down by customer. How much I had to pay for customer A, customer B, customer C, and D. Okay, that's what the subsidiary ledgers is all about. Okay, individual accounts receivable, accounts payable. Okay, and there's something called permanent account. Permanent accounts represent the basic financial position elements, which is the balance sheet. Permanent accounts is sitting in the balance sheet. Asset accounts, the liability accounts, and shareholders' equity. Those are permanent accounts. Those doesn't go away. When you close the books on a yearly basis or quarterly basis, you carry it over to next period, the balances. Okay. However, how about a temporary account? Temporary account doesn't carry over to next year. When you close the books, you're done. You start with the zero balance the next year. Like expense account, right? Revenue accounts, all that stuff. We usually zero that out every year, every time when you close the books and move it to retained earnings. That's what we do. Temporary account close out to retained earnings. Whether it's a income, the loss or gain, or profit or loss. We're going to move to retained earnings. Okay, let's take a look at this example here. What is this? It says temporary account would not include, you know what the temporary accounts are. Temporary accounts, those accounts we put in an income statement. Now, is a salary expense an income statement item? Yeah, right? That's the temporary account. We're talking about a temporary accounts. Would not include This is a temporary account. An accounts receivable or rent revenue is a temporary account. Okay, now this is the one. Accounts receivable is not a temporary account, as I said. It's a balance sheet account. It's carried forward to next year. Okay, answer therefore is B. Is the right answer for that one. Okay. Okay, the steps we're going to do. What exactly we're going to do when we put together, when we record a transactions. Step 1, there are 10 steps. Sometimes we can very simple steps here. Let's take a look. During the accounting period, what we're going to do when you have a transaction, say obtain information about external transaction from source document. I think we're getting into, we're going to look those items a little later. What are source document? What are you talking about external transactions? Suppose we make a sale. When you make a sale, we issue an invoice. Or when you purchase something, we get an invoice, right? So that's the source document to report. Shipping document, those types of things. Then you analyze the transaction, record the transaction in a journal. And journal means, we said, a subsidiary ledger kind of thing. Journal, you had a journal entry you got to put. Debit and credit, that's the journal. We'll see that a little later. When you have any transactions, to make sure you have to put the right place. You debit one side and credit other side. That's how you're going to balance your balance sheet, your income statement. Record the transaction in the journal. Suppose you say buy goods. You purchase good for cash. If you pay cash, what entry you're going to make? Purchases or inventory going to be debited, and you're going to credit cash. That's your journal entry. Now from the journal entry, you post the journal to the general ledger account. Okay, it's usually automatic. When you make a journal entry, it goes directly to those accounts. That's the way it's set up in the system. Okay. Now this is during the accounting period. When it comes to end of the accounting period, what do you have to do? You put together step 5, prepare an unadjusted trial balance. Based on all these accounts, to list all these account balances by account name. That's the unadjusted trial balance. Okay. Then you have record the adjusting entries and post to the general ledger accounts. We are also going to look at what adjusting entries are. Sometimes these transactions, we have other things that need to put to close books other than what this transaction. Like suppose let's say we see in the prior couple of examples, the supplies. We use the supplies, right? But here we don't have that. So we're going to make an entry. What entry we going to make? That's what we call adjusting entry. You debit supplies expense and credit supplies to make that entry. And another one, depreciation. It's not here. So we got to put the depreciation numbers also. Okay. So remember, those adjusting entries is very important to make the income statement correct, accurate. Then once you're done with the adjusting entries, you come up with the adjusted trial balance. Adjusted trial balance may be different balances. Okay. Now you got to adjusted trial balance, use that to put together your financial statement. Okay. At the year end, so at the end of the year, step 9, close the temporary account to retain earnings. As we said, temporary accounts, income or the revenue accounts, expense account, we're going to close out to retain earnings, prepare post-closing trial balance. We'll see how much we can do. I'm going to look at all these transactions. If you look at the one transaction all the way from beginning to the end, you understand how this process works. Now, here's the step 1 and 2 in detail. To identify external transaction affecting accounting equation, obtain information about transaction from source document. We went through this already. This is just the reading. I'm not going to go over that again. You can see the examples. If you're external type of transactions, the sales invoice, bills from suppliers, cash register tape, those kind of things. Then you have a transaction, you analyze. What do you mean analyze? Sometimes you may have errors on those items. So you got to look at it before you put them in the system. Okay, that's what it means. Here is the transaction 1. I'm not getting into that. I think we went through a couple of times already. Yeah. An attorney investing 50,000 to open a law office. You get assets. What's the first entry going to be? You cash 50,000 debit and credit owner's equity. You can see that. That's owner's equity. Okay. Then transaction 2, you borrowed money. Remember. So what's going to happen? The cash increases. Original 50,000 from owner's investments, and you got a 40,000 coming in as the borrowed money, and it created a liability, notes payable. Okay, that's transaction 2. So transaction 3, remember the supplies that we purchased on account. Again, supplies account debited and accounts payable credited in here. So create a liability. So you can see the building up. Okay, assets increases each item, each step you get these balances. Okay, the original 50,000 assets, and then borrowed money 40,000 increases to 90, and then this supply costing. I think the assets. What happens here? These are supplies. Okay, the supplies costing 3,000 were purchased on account. So what happens? Supplies increases by 3. Total assets has 93 now. Again, at the same time, you get the liabilities and owner's equity. See the accounting equation going similar directions, the same way, equal. At this point, there's 50,000 and 50,000. At this point, you get a 90,000 assets, and total this plus this 90,000, right? So you can see every transaction added to your financials is supposed to have a balance in the balance sheet. Okay. Now we got the services were performed. When we have that situation, asset increases. That's accounts receivable. That's 10,000. Owner's equity also increases by the same amount. You keep adding the building. Okay. The salaries were paid. 5,000, that reduces your assets by 5, and also owner's equity, as I said, that's an expense. Expense decreases your owner's equity. I'm going to keep repeating, then you don't forget. Okay, remember that owner's equity consists of a couple of things. One being retained earnings. Retained earnings is where you put all your gains and losses. Okay. Right here is the supplies used. You reduces another 500. You reduce asset by another 500. At the same time, you reduce owner's equity by the same amount. Again, you keep doing this. I'm not going to go through all these. Now we went through this one already. So let's see what else we have. Okay. Step 3, record the journal or record the transaction in a journal. When you have a transaction, you record in the journal to provide a chronological record of all economic events affecting the company. Each entry is expressed in terms of equals, debits, and credit. That's the journal entry supposed to accomplish. Okay. Special journals record the repetitive type of transactions, sales journal, and journal, any transaction not recorded special journal. Okay, just readings. Okay, then we have here, when you this is the journal entry for borrowing money. I think we went through that already. Cash debit, notes payable credit, simple transaction. This external transaction in 2020. Probably these are the ones that we're going to use going forward when you look at the transactions. Okay, let's take a look what we have here. I'm pretty sure you can see that. 2 individuals, each invested 30,000 in the corporation. Each investor was issued 3,000 shares of common stock, borrowed 40,000 from the bank. All these transactions. Let's see what we have. Next slide. Okay, this is the first transactions. They said 2 individuals, each invested 30,000 in the corporation. Each investor was issued 3,000 shares of stock. So it's a common stock. What is the entry? Cash, debit, you get the cash, right? The money, they put the money into the business. That's 30,000 each, you get 60,000. And then they issue shares of the corporation, the common stock get credited, 60,000. Very simple, straightforward transaction. Okay, the next transactions, they borrowed 40,000 from a local bank and signed 2 notes. The first note, 10,000, requires a payment of principal and 10% interest in 6 months. You got to remember those facts also. When you close the books, you may need to do certain adjustments. That's what they said. Okay, there are 2 notes, a certain interest rate, certain dates. All these things is important to keep in mind. Okay. The second note, 30,000, require payment of principal in 2 years. Interest at 10% is payable each year on July 1st and July 1st, 2019 and July 1st, 2020. So what's the entry? This is just the transaction, the original, initial transaction. Cash 40,000, notes payable 40,000. That's it for now. You're not making any interest adjustments. Interest adjustments you do. Remember, there's interest involved at the end when you try to close the books December 31st. Okay. The next one, pay 24,000 in advance for 1 year's rent. Remember, this is 1 year rent. This is July 1st. If you paid 1 year rent, so if you're closing books in July 12/31, you 6 months. So remember, we got it's a prepaid. Why we prepaiding this? Remember, that's the prepaid is you paying in advance. Prepaid rent. It's an asset. You pay cash. At the end of the year, you have to make an adjusting entry. Remember what we did? We put all these accounts and then make an adjusting entry at the year end before we close the books. The reason we put a prepaid rent 24,000, not rent expense, because the total amount is not for the entire year, one, and we just signed the lease, so we did not use it yet. Okay, it's not rent expense yet until we use the time expires for the rent. Okay, office equipment, the purchase 12,000 cash, simple. Office equipment debit and a cash credit. Then you have purchased 60,000 of clothing, inventory on account from this entity, inventory debit and accounts payable credit. Remember, this is a very simple transaction. If you know where is debit, where go debit and credit. Inventory, an asset, it's debit. Remember, that's the thing you have to remember. Assets, debit. Liability is credit, always. Income is credit. Expense is debit. Owner's equity is credit. Remember those things, then you'll be fine. Okay. Purchase 2,000 of supplies for cash. Supplies 2,000 debit and cash credit. You got this. During the month, sold merchandise costing 20,000 for 35,000. Now remember, this one we have 2 steps transaction. What is that? If you look at first the sales, right? Cash, you got 35,000 cash sales, and you have debit cash and credit revenues. Okay, but how much that merchandise cost you? You got to record that as well. That's 20,000. So what are you going to do? Remember, we put the total amount when we purchased to inventory. Now we are selling it at a profit, right? So cost of goods sold is 20,000. That's the cost for that amount. And inventory reduced by that amount, debiting 20,000. Everybody understand that, right? Remember, as I said very first time, if you don't understand any of these, send me a note, send me a message. Okay, I can explain to you individually or however you want. If somebody understands, everybody else might understand it well. But if for whatever reason, if someone don't understand what we're doing here, please make sure to send it. You're here to learn. Okay, don't be shy to raise questions. Don't be shy to ask questions. If you don't understand, I can clarify. Okay. Now we are recording the sales, the sold clothing on account, because another sale. It is now on account. A similar transaction, except the fact that it was sold on account. Account receivable. Instead of cash, now you're creating account receivable, a debit, and sales revenue. Everything else remains the same. Okay, now we're looking at two different type of inventory, sales of inventory. Perpetual inventory system companies use sometimes, or periodic inventory system. What is the difference between those two? For the most part now, with all these computerized, just very sophisticated computerized systems, for the most part people use this perpetual inventory system. Inventory and cost of goods sold account are continuously updated for purchase, sale, and return of merchandise. As soon as you scan the item, you get updated, right? When you purchase items, they put it in the system, scan everything, they put it in the system. So when you sell that item, remember, you go to the register, just scan it, boom, they're going to reduce. They could reduce inventory by that amount, the costs, of course. Okay, and when you return item, again they're going to put it back in the inventory. But when it comes to periodic inventory system, inventory and cost of goods sold are updated at the end of the reporting period. You got to go manually count how much inventory you have in the warehouse, whatnot, and then update at the time you're closing. Okay, sometimes the perpetual inventory system might be misleading. The reason being, there's some, if somebody steals items, so it's not get recorded. That's the drawback with the perpetual inventory system. Okay, the record receipt or prepaid rent. So what's happened here? This subleased a portion of the building to another person, receive $1,000 in advance for the first 2 months rent beginning on July 16. So journal entry going to be July 16, you get cash 1,000 and you debit deferred rent revenue. What I mean deferred, again, like prepaid rent, it's a deferred revenue because you subleased the building that you rented, but that's for the next 2 months. So you cannot really treat that as a revenue already. It's not revenue until that time expires. Okay. Okay, paid this clothing supplier 25,000 on account. Accounts payable reduced by that amount and cash decreased by that amount. Okay. All right, this is a very simple, straightforward. I just go through it. Still, as I said, if you still have some issues in understanding, just let me know. Paid salaries to employees. First half of the month, 5,000. Salary expense and cash credit. Receive 1,500 on accounts. So you get a cash debit, accounts receivable credit. Now, the corporation paid to its shareholders cash dividend 1,000. As I said, the dividend is it's like that's what you're going to get for your investment. You put a money, remember that $30,000 each person put in, they get $1,000 of dividend. Usually, this is the payment. Retained earning you reduce by that amount and cash paid. You have to have retained earnings to pay dividend. That's usually. Otherwise, what's going to happen if you don't have retained earnings, if you don't have a profit to pay dividend, what's going to happen? You're simply paying their investment back, which is not a dividend. It's the return of capital. Okay, it's beyond this course, but I just want to point that out. Let's take a look at this one. Recording an expense. Recording an expense for salaries incurred and paid in cash would be recorded by, remember what they say, recording an expense for salaries incurred and paid in cash. How are you going to do? Debiting liability. There's no liability here, right? Debiting an expense. So good. Debiting cash, no. You usually paid cash. Cash usually credit when you make a payment, right? Crediting an expense, that's an incorrect. Usually expense you debit. So what do you have here? This is the right answer. Debiting an expense, okay? Now we'll look at this one. This journal entry to record issuance of common stock in exchange for cash. You're issuing common stock and getting cash. Involves a debit to common stock and credit to cash. No, right? It's not right. Usually you get cash as cash debit. We said common stock is credit. Debit to cash and credit to common stock and retained earnings. This has nothing to do with the retained earning. So that's incorrect too, right? Debit to cash and credit to common stock. Okay, that sounds right. It's the right answer for that. Okay, the posting. General ledger, general journal, this get posted to this. Okay, so I'm not going to go through. Usually that happens when you put those entries in the general journal, it get posted to the right accounts in general ledger. Okay, now we already recorded all the transactions, right? So what we're going to do now, the step 5 is to prepare an unadjusted trial balance. Take all the balances, whatever we have now, and put together like a schedule. That's all it is, schedule, putting account name and the amount, okay, whether it's a debit or credit. That's the unadjusted trial balance. List of general ledger accounts along with their balances. Purpose, to check for completeness and prove that accounting equation is in balance. Debit balance equals to credit balance. All right, sometimes you have offsetting errors and whatnot. That's one of the reasons that we put together the unadjusted trial balance before we making any adjustments. Okay. Now here is how it looks like. You can go to your textbook and look at all these items in detail, but this is just to show you how an unadjusted trial balance look like. Cash, accounts receivable, all these, and also you should have here, you got all these account, expense account, revenue account, salaries expense, cost of sales, and the sales revenue. Okay, the unadjusted trial balance total is 174,500. Right, remember that. And then you have to do, as I said, adjusting entries to post to the ledger. What adjusting entries you're going to make here? Record the effect of internal events on the accounting equation. What internal event? Sometimes we have depreciation expense. You got to record that at the end of any period when finance statements are prepared. Objective to implement the accrual accounting model. All right, let's see what they are now. I'm pretty sure you all know accrual accounting. even though you might not pay, whether you receive cash or pay cash, it's not a matter. As long as you provided the services, you made the sale, or you consumed the goods or services, then you have to make an adjustment. You got to account for that, right? So that's an accrual method. To ensure that all revenues are recognized in the period goods or services are transferred to customers. As I said, if suppose we'll say you made a sales of 100,000 on December 30th, okay, December 25th, on Christmas Day, but you didn't get money. You're going to get money in 10 days, January 5th. So if that's the case, your closing books is December 31st. So what are you going to do? You did not get the money, you didn't get paid, but you made the sale. Sales final. You know for sure you're going to get paid. So you got to take that into account. So that's, you make an accrual means when you make a sale, you credit sales and debit accounts receivable. How about the salaries and that stuff? You have to pay for employees, right? Until you paid, suppose you say December 25th is the last payment you made to the employees, but they work another 6 days until December 31st, you must pay. So that's an accrual. Okay, the next payment, next salaries, next paycheck is going to be out in, say, this January 5th. In the same way, you don't wait until January 5th to record that transaction. You have to record a transaction 31st, how much you owe for that 5-6 days. That's an accrual. Okay, that's what we call it. Okay, and you have to make sure you revenue recognize. You have to make sure your expenses are recognized at the period incurred. Adjusting entries need prepayment. Remember, we prepaid expenses, supplies, rent, and deferred revenues. So you got to make adjustments. An accrual, accrued liabilities, accrued receivable. You got to make that too. An estimate. Estimates is simply if you have warranties, if you have depreciation, all kind of stuff. Okay. Okay. Cost of asset acquired, prepaid expenses in one period and expense in the future. Remember we said like rent, well, not necessarily rent. You've made a payment for rent and also supplies, right? Your cost of asset acquired, say supplies, much easier. One period, an expense in a future period. So in that case, you credit the asset account and create an expense for that period, whatever the amount. Okay, so what happens? Financial statement, income statement, incomes reduces because expenses, we create an expense, and balance sheet asset also reduces. Okay, simple. Okay, just quick example. Let's take a look at that example. This is Clothing Corporation purchased 2,000 of supplies in July. Assume that dress right determined at the end of July $1,200 worth of supplies remain. So how much did we spend? How much we used? Consumed $800. So usually what we do, we started with the balance of 2,000. We credit the amount we used, utilize, credit supplies, and debit to supplies expense. That's it. Okay. Okay, we're going to do the similar process for rent. This is prepaid rent. At the beginning of July, the Dress Right Clothing Corporation paid $24,000 to its landlord, representing 1 year's rent. So if you are closing your books in December 12/31, your July 31st, and how many months we got? This is each month. Actually, this is July, right at the beginning of July. So just July 31st. He's going to close the books on July 31st. 1 month. So monthly rent is $2,000. 24,000 divided by 12 gives you $2,000 monthly rent. So since now end of the month, you're going to charge rent expense for $2,000 and prepaid rent $2,000. That's it. Okay, that's for the rent expense adjustments. Now the depreciation part. Here is an office equipment was purchased during the month of July for $12,000. Assume that its useful life is 5 years. So again, you got to allocate whatever this 5-year depreciation over the life of this asset, which is 5 years. Because monthly basis, how much it says, they divide by 12,000 divided by 60 gives you $200 depreciation expense per month. So that's what you got, 200. Okay, depreciation expense you debit, depreciation expense debit for 200, and accumulated depreciation 200 credit. Now let's take a look. This is a quick example. What do we have here? The correct amount of prepaid insurance shown on a company's December 31st, 2018 balance sheet was $1,400. Okay, let's say it's a correct amount of $1,400 balance sheet amount, right? So on May 1st, 2019, the company paid an additional insurance premium of $1,100. This start with, what is the starting balance? It says starting, this is December 31st, get a $1,400 prepaid, right? Prepaid insurance. Okay, let's put the numbers here. It's easy. $1,400, that's the beginning balance, right? Beginning balance $1,400. So they also paid during the year, on May 1st, 2019, company paid an additional insurance premium $1,100. So extra got $1,100 payment. In December 31st, 2019, the balance sheet, the amount of prepaid insurance was correctly shown $1,000. So balance sheet, okay, what's the balance? Ending balance is 1,000. So what are they asking? The amount of insurance expense should appear in the company's 2019 income statement. What do you simply do? You add these two together. What do you have here? 2,500, and then minus the interest expense should give us the 1,000. That's 2,500 minus 1,500, right? Should give the 1,000. So the answer is C. That's your insurance expense for the period. That's how you compute interest expense. Okay. Right, deferred revenue is a similar cash received from customers in advance, providing a good or service. So what we got here, you get money in advance. It's like a deposit of some sort. But you cannot really recognize as revenue until you provide or deliver, you ship that product or perform the services, right? So at the starting point, when you get the money, you credit deferred revenue, not revenue. Okay, you get the cash debit, and deferred revenue credit. So what's going to happen here? Represent the company's obligation to provide goods or services in the future. You debit a liability, the deferred revenue, and revenue credit when things are done. Okay. Let's take a look at this one. What is this? Contra Costa Times company reported 17,000. The liability, and it is a 2018 balance sheet for subscription revenue received in advance. In 2019, 68,000 was received from customers for subscription, and 2019 income statement reported subscription revenue 69,700. What is the liability amount? Deferred subscription revenue, that will appear. Okay, let's take a look now. What happens here? They reported the beginning, got 17,200, right? That beginning balance. That's the deferred revenue, the liability. Then During 2019, they got a 68,000 was received from customers. So 68,000, you can just buy that. You add to 68,000, that's also deferred revenue. Okay, 2019, and in 2019 income statement reported subscription revenue 69,700. So you got these amounts, right? So what's the total? You got a total 25, that's 8, right? 85,200 total. Yep, $85,200 in total. But revenue, when you have revenue, what do? You debit the deferred revenue and credit the revenue. So what you're supposed to do, 69,000, you minus this, 69,700, right? 69,700 minus gives you your balance. Revenue, deferred revenue, subscription revenue, that should appear in your balance sheet. What is this? Now that gives me 5, right? And that's 5 also. So 1, right? 15,500. It should be this one, 15,500. That's your balance, or deferred revenue, the liability. Okay. Okay, now we're looking at something called accruals. I'm pretty sure you heard this accrual. Involve cash flow that occurs after either expense or revenue recognition. Include accrued liabilities or accrued receivable. What is this? We can take a look in some example. Many accrual include external transactions that automatically are recorded for a source document, from a source document. Some accrual involve internal transactions and require adjusting entries. I'm going to look at some examples. You will see how these things are going to work. Okay, accrued liabilities represent liabilities recorded when an expense has been incurred prior to cash payment. So suppose you say December 31st closing, but you purchase something, or say salaries. Salary is going to debit salary expense and credit salary payable. Because supposing, just to give you an example, say December, last salary paid 12/25th. Okay, then in 2 weeks, say January 6th, the next payment, next paycheck coming, right? So it's 12/31 right here. When you close the books, you paid about 6 days worth of, you got the workers work 6 days. So we owe them 6 days worth of salaries. So since that part belongs to our closing this year, so we already the benefited from the service of employee. So we got to account it for that. Okay, we got to report that expense. So that's why the salaries, you debit the salary expense and credit salary payable. But the following year, when January comes, this is what happens automatically. It's automatic reversal. It gets reversed automatically. Okay, what do you mean reversed? You credit expense and debit payable. Why we do that? Because next time when the payroll hits, that amount is going to get charged to the right amount. If you don't reverse that, it's going to be duplicate. Okay, double counting. So that's the reason it's automatic reversal. All these accrued items usually is automatic reversal. Okay. Yeah, that's the example that I just mentioned here. July 20th, Dress Right Clothing Corporation paid employee $5,000 for salaries for the first half of the month. Assume that salaries for the second half of the July, $5,500, will be paid in early August. So this 5,000, this 5,500, we didn't pay for the July. So when you close the books in July, you got to make an entry. That's you call adjusting entry. That's accruing the liability. Salary expense 55, salary payable 5,500. That's how you record accrual. Okay, remember we said we have, they borrowed money, $40,000 from the bank. So we got the two notes that we issued, one of which I think this says, okay, the unadjusted trial balance, just right, reflect the balance in notes payable, 40,000. The company borrowed this amount July 1st, 2018. So evidenced by two notes, each requiring 10% interest. So if you borrow money at the beginning of the month and end of the month you're closing books, 1 month interest we need to accrued 40,000. Simple, very simple transactions, right? 40,000 times 10%. That's for the whole year, and for 1 month gives me $333 a month interest. So what's the entry going to be? Interest expense. We're going to be the interest expense for $333 and interest payable $333. Okay, that's the entry for that adjustments. Okay, how about looking at this one? Gary borrowed, the Gary's Grocery borrowed a $12,000 at 8% interest on May 1st, 2018 with principal and interest due on April 31st, 2019. That's 1 year note, 8% interest. The company fiscal year end December 31st. What amount of interest expense would appear company's income statement for the year ended December 31st, 2018 related to the loan? So what you should do, you take 12,000, let's do that together, 12,000 times 8% interest as for how many months? So this is May 1st, right? May 1st through December 31st is 8 months. 8 months. Okay? So what are you going to get? Actually, what are you going to do? 8 over 12, right? 8 months. So what do you have? You compute 12,800. 12,000, not 800. $12,000 at 8%, right? So for 8 months, what do you get? $640, right? 8% time of this, and allocate over 8 months for the 8-month period. The $640. That's how you kind of compute, right? Okay. It's easy example. Accrue receivables, so similar. Okay, again, if you lend money, this is a receivable, accrued receivable. You're going to do the same kind of entry. The debiting accounts receivable or interest receivable, not accounts receivable, interest receivable, and crediting interest revenue for the period. Okay. Here's the interest revenue. You're going to look at the same exact similar fashion. Assume that Just Right's loan another corporation $30,000 at the beginning of August. Term of the notes called for payment of principal $30,000 and interest $8,000 in 3 months. So this is in August, right? Beginning of August in 3 months. So if you're closing the books on August 31st, so this is how much you're going to record. Okay, 8% for 1 month is $200. Interest receivable and interest revenue. You get another type of adjusting entries that we're going to make. Those are internal type of adjusting entries. Depreciation expense, an estimate, and bad debt expense, also an estimate. We don't know exactly how much that's going to be. Estimate in the sense the useful life of an asset. We usually depreciate assets. Suppose you have machinery that costs $100,000. You estimate to have 10-year life, but we're not sure. It might break down halfway through the life, but we are not sure. That's an estimate. So then also the residual value. If you think that you got a $100,000 machine, okay, it's going to last 10 years, and then you say after 10 years is worth $10,000, but that's also an estimate. So when you depreciate it, you have a original value, the minus the residual value, and what is 90,000 get depreciated over the 10-year period. And the same thing here, the bad debt expense. People, we have to make some adjustments to the bad debt expense that we think that we are not going to collect. The sales, you made a sale, somebody might not pay you back, so those are the bad debt expense. Okay. Then once we've done with all these adjustments, what are we going to do? You have to prepare an adjusted trial balance. You start with unadjusted trial balance, remember that, then you make all these adjustments and come up with, see, step 5, trial balance after adjusting entries have been recorded. Step 5, you get an unadjusted trial balance. Step 6, we did the adjusting entries. Step 7, you came up with adjusted trial balance. We're getting there. The step by step, all the transactions we learn starting from the beginning, and how we're going to put together your ultimate financial statement, the balance, income statement, and balance sheet. Here is the adjusted trial balance right here. Started here unadjusted trial balance, right? Now we got all these adjustments. Interest expense adjustment. Remember we did adjustments, depreciation expense, rent expense, supplies expense. Those are adjusting entries. Then you have the adjusted trial balance, the balances. That's the ones that we're going to use to put together your financials. Okay. All right, the preparation of finance statement. Again, step by step, we came all the way here. Now, putting together financial statement. Primary means of communicating financial information to external parties through, we have to put an income statement telling you what exactly happened during the year, right? Showing the results of operations, whether we make money or we lose money. Okay. Statement of comprehensive income. So this is other items. That's also a part of income statement below your regular day-to-day operations. We put something called statement of comprehensive income. That usually, to some items that you put in there, it not necessarily impact your income. So we're going to look at some of those items a little later. And then we have a balance sheet. Balance sheet shows you what we have at the end of the day, at the end of closing December 31st. What do we have? What asset do we have? What liability do we have? What equity we have? That's the thing. You're just exactly showing as of a certain date what do we have. That's the balance sheet. And a statement of cash flows. What is that? A statement of cash flows shows us how much money we got and where the money went, how we spent the money that we received. This is two different things. Income statement shows us the operating results, whether you collect cash or not, right? You made a sale but you didn't collect cash. That's going to be reported in income statement to compute your income or loss. However, the statement of cash flow shows, okay, we made this money, how much cash we received in actuality, and how much money we spend on expenses or whatnot. Okay, then starting with the cash balance, say $100,000, we ended up with $120,000. So increased cash. Okay, you got to see what happens. Okay, that's like a reconciliation. Okay. And also, now we know what this is, statement of shareholders' equity, showing your capital, your paid-in capital in excess of par, and return earnings. Okay, those are the things that we put together for the external parties. Okay, here it is, the income statement. You start with the revenues, you can see, and cost of sales, gross profit, and this is what we call multiple step income statement. All the steps: revenues and cost, gross profit, operating expenses, and then you have all these items. Okay, it says change statement that reports the change in shareholders' equity, retained earnings. Here, now what happens here? Net income. If nothing else, this is the net income for the period 2009-17. But if they don't pay dividend, so that's the amount going to go to retained earnings. Okay. Balance sheet, we already know what a balance sheet going to show us. The present the financial position of a company. Organized list of assets, the liabilities, and shareholders' equity at a point in time. This is very important. Not like an income statement. Income statement shows us what happens during the year, whole period, January 1 through December 31st. But a balance sheet is showing us where we are at a point in time at December 31st. Okay, we have a classification according to common characteristics. We classify the balance sheet different. It's a current assets, we have current liabilities. You got current assets consist of cash, which will be converted into cash items, and some other items will be used up within 1 year, operating cycle, whichever is longer, like accounts receivable, all kind of thing. Okay, and inventory. And current liability is a similar liability that will be satisfied within 1 year. That's what we call current, within 1 year. Or the operating cycle, whichever is longer. Operating cycle may be sometimes 1 year and 2 months, depending on the situation. Okay. There are non-current assets also, include property and equipment, long-term receivable, long-term investments. Those are non-current type of assets. And the long-term liabilities include all liability not classified as current, long-term payables, or such. Okay, the shareholders' equity, we got a list. The paid-in capital portion of equity, common stocks, and retained earnings. So these are the readings that you can take a look. This is just a balance sheet example. Looking at that entity that we are looking at, we discussed so far. Okay, you got all these assets and all these liabilities and equity. Okay, statement cash flows. Now, when it comes to statement cash flows, we provide information about cash receipt, as I explained before. It shows us cash receipts and cash payment, right? Cash disbursement. Cash refer to cash plus cash equivalents. Cash equivalents is like you have a bank drop or whatnot, you can convert into cash at short notice within a couple of months or whatnot. 3 categories of transactions affecting cash. We have, when we put together cash flow statement, we got to list this way. Okay, we got to put this one together. Under operating activities, inflow and outflow of cash related to transaction entering into the determination of net income. What are those? Operating activities, sales, purchases, payment, salaries, the rent, and all that stuff that goes into operations, right? So at the end of the day, you get a net income. How do you get to that net income? That's what operating activity is going to show you. Okay, and then investing activities. Again, this is cash basis. Investing activities involve the acquisition and sale of long-term assets. That's an investment in the business, right? You buy a building, that's an asset. That's an investment type of activity. All right. Then you have financing. How are you going to finance the business? Whether you sell stocks or you borrow money. Okay, inflows and outflows of transaction. That's creditors involved with borrowing money from a bank. That's creditors. That's an investment for the company. That's considered investing, rather the financing activity, financing the operations. Okay, we're going to do some cash flow examples probably later, then you understand that well. Now the cash flow statement, again, I want to mention, we got to put in two different ways. We can prepare in two different ways: direct method and indirect method. A direct method is start with the cash sales. Okay, if you have sales with the cash sales, that's what you're starting with. Okay, receipts, cash receipts, and cash payments. But if you are using an indirect method, which we use for the most part, start with the net income. You came up with the net income, you have to make adjustments to net income to see the cash, how much the cash generated from all these activities. Okay, here is a typical cash flow example. Now this one is a direct method, so you can see cash flows from customers, from rent, and cash outflow, it goes up. Okay, then you have that's for operating activities. The investing activities, you have purchase of this equipment. Financing activities, you have common stocks, notes payable, and dividend. Also consider the financing activity because you're selling stocks, and when you sell stocks you get the money, and at the same time you got to pay for the investors, that's the dividend. Okay, so that you can see where we are. Okay, that's a direct method. Okay, statement of shareholders' equity discloses the source of the changes in various permanent shareholders' equity accounts, from investment by owners, distribution to owners, net income, other comprehensive income. All this is going to be reported in the shareholders' equity section. Now you can take a look in the books, might give you more detailed information. Okay, what we have here, the closing revenue accounts to income summary. We did say we don't carry temporary accounts to the next year or the next period, right? So what we're going to do, we just close them out. So sales account going to close, assuming that the fiscal year end interest rate is July 31st. Using the adjusted trial balance, we prepare the following entry to close revenue to income summary. We've got a revenue, going to close it out. Revenue usually is a credit balance, remember? So when you close it, you debit it and put it into income summary. 38,750, remember that. Okay. You can look at a couple of items in the textbooks, probably get a good understanding how that works. Again, same thing. Now when we have expenses, expense accounts are debit, so you got to close it, you got to credit. Okay, here they are. Now expense account, closing expense account to income summary. What we do here, income summary, debit, and you're going to credit all these expense account, so that expense account going to be zero when you start next year. Okay, that's the purpose of closing this out. So what happens now, income summary, we have a debit and credit. The difference between those two is going to transfer to L. If you remember, it's going to transfer to retained earnings. Okay, income summary, that's the net income. Net income going to income summary, going to change to move to retained earnings. Okay, we're doing well, everybody. I know this is I'm going a little fast. It's not like in-class setting, but I think we learn a lot. We learn a lot, actually. As I said at the very beginning, we got to cover a lot of materials. We have only limited time. You elected to take this short session, 8-week session, but we'll do whatever we can to give you all the information you need, all the materials you need to learn, actually, everything that you're supposed to learn in this course. Okay, and again, it's your responsibility to go over maybe a couple of times. Now, since you have a recording, that's the good thing. Bad thing, you don't have access to me to ask questions. and we don't have a discussion type of environment here when you have online course. But the good thing is that when we do have a recording, you can go back and revisit if you didn't understand the stuff that we discussed. And even if you don't understand still, you can still send me an email or message note, then I can go again, okay, even individual basis. All right, prepare post-closing trial balance, including that the net amounts from retained earnings that you put there. So you got all these accounts now, okay. Year end, prepared at a year end to verify that the closing entries were prepared and posted correctly. Then from there, you got to put the financials. Okay, conversion from cash basis to accrual basis. How are we going to do that? Now, when we put together cash flow statements, we're going to look into that in detail. I'm pretty sure we have one chapter. I'm not sure this is intermediate 2 or 1, but in cash flow statements, we go through a very detailed analysis. How we're going to prepare cash flow statement, given, especially indirect method, given certain facts, okay, about accounts and transactions. Let's see what we have here. Produces a measure called the net operating cash flow. Cash flow is, if you're using the cash basis accounting, it gives you a net operating cash flow. Accrual, I think we mentioned that already. This is net operating cash flow if you are using a cash basis accounting. If you're using accrual basis accounting, we get a loss or income, right? Okay, the measure of the entity's accomplishment and resources sacrifices during the period, regardless of when the cash is received or paid. Okay, we discussed this a few times, we mentioned that a few times, so you're not going to forget it. Okay. All right, here we go. Just give a few examples before we're done with the chapter. They give you this example. Take a look at this one. Example 1 of conversion from cash basis to accrual basis. Suppose a company paid 20,000 cash for insurance during the fiscal year, and you determine that there was 5,000 in prepaid insurance at the beginning of the year and 3,000 at the end of the year. You can determine insurance expense for the year. How are you going to do that? Okay, let's take a look at this quick example. Says it started with 5,000, right? Fiscal year, you determine 5,000 in prepaid insurance. You got $5,000 sitting here. Then you pay cash at 20,000 during the year, and you don't know this amount yet, right? You had to figure that out. Now they're saying at the end of the period you got $3,000 remaining balance. So if that's the case, what you do is the cash paid, or rather insurance expense for the year. These are cash, right? This is a cash paid. We don't know. This is a cash beginning of the year. This had this much cash paid, 20,000. So at the end of the year, you got $3,000 sitting, prepaid insurance. So what is the expense? There's difference between these two. You got 25,000 minus something gives me 3,000 at the end. That missing one is 22,000. Okay, that's the expense for the year. Now see, you can see the difference. Cash, we paid 20,000. If it's a cash basis, this is the only amount that we care about, right? 20,000 cash paid. But when you do a accrual basis, so you got to convert that to accrual. See, this is the expense. This is what we're going to use when you do an accrual basis accounting. That's the difference between those two, cash and accrual basis. Remember that, okay? Here's another example. Suppose a company paid $150,000 for salaries to employees during the year, and you determine that there were 12,000 and 18,000 in salaries payable at the beginning. Okay, you got a 12,000 at the beginning and 18,000 at the end, beginning and end of the year respectively. Determine the salaries expense. Okay, you paid, company paid 150,000, so that's cash paid, right? Cash paid 150. You started with, this is payable. Remember, now it's at the end of the year, so you didn't pay entire salary, so you got to make an accrual. This is an accrual. You made an accrual 12,000. Now then you paid 150,000. So you, at the end, you have 18,000 to be paid. So what is the current year expense then? 156,000. So if you put a T account, that's much easier for you to understand, right? See, start the balance 12,000, then cash paid, this is the payable, right? So cash paid 150, the salary expense. Now this is, you got to report here and take out the 156,000, debit, credit here and debit to expense, right? So at the end we got 18,000. So much easier if you put a visualize, you put in a T account and it's understand better. Okay, now item 3, example again. Using T account, assume that the amount of cash collected from customers during the year 220,000. Okay, this is account receivable. Okay, and you know that account receivable at the beginning of the year 45,000. You know that it's given. They had accounts receivable 45,000. Now what do you do when you make a cash sales? You debit account receivable, credit cash. Now I mean credit accounts, credit sales, and debit accounts receivable. That's what you did, right? So since we do not know that, we have other amounts. So given the other information, you should be able to come to that number. Okay, so we don't know how much is the sales. We know cash collection, this is a cash basis. Cash collections at 220, and we have ending balance accounts receivable 33,000. So what is the credit sales then? You started with 45, we collected 220, and we ended up with 33. Then the difference is 28. Okay, I think the T accounts gives you better the visualize the numbers and how that works. Okay, let's take a look at this example. Dan White, the maintenance record on cash basis. During 2018, the company collected 75,000 from its customers and paid 21,000 in expenses. Depreciation expenses 8,000 would have been recorded on an accrual basis. Over the course of the year, accounts receivable increased 7,000, prepaid expense decreased by 5,000, and accrued liability decreased 4,000. Then accrual basis net income is how much? It's a little complicated one, but we can work on that. Okay, now this is the cash basis. Says select collected cash 75. We have to start with this is the cash basis accounting. Now we have to come to accrual basis net income, right? Okay, so this is a cash collected. So that's what we have for cash basis. That's what looks like income they reported. Let's see, 75,000 cash collected. Okay, so customers, okay, that's the cash collected from customers and paid 21,000 in expenses. So 21,000 in expenses, 21,000 in expenses. So what do we have here? 4 and 5, 54,000, right? What is 54,000? 54,000 cash basis net income, right? Now you figure out how much you collected and how much you paid in cash. Now this is cash basis net income. That's not what we need. We need accrual basis net income. Now we have to make an adjustment. Now this is like a cash flow statement. So you start with cash basis net income. what adjustments we're supposed to make. What other information do we have? See, depreciation expense 8,000 would have been recorded on accrual basis, which we did not record here, right? So we got to deduct depreciation expense from that amount, okay? And then what else we have? That part is easy, right? Over the course of the year, accounts receivable increased by 7,000. When we say accounts receivable increase means what? I'll give you an example. Accounts receivable right here, okay? Suppose we'll see we had accounts receivable, it's a debit balance, 10,000. Okay? We have 10,000. So what we do when we make a sale? We credit sales, we debit accounts receivable, right? Suppose we'll say made a sales of 50,000. So made a sales of 50,000, credit sales, we put over here, right? Then what do? We collect money. This is how much money we collected, 75, right? So what if we collected less than what we supposed to collect during the year? If all the customers paid, we should have collected little less, right? Little more, right? So what we saying here, accounts receivable increased by 7 means we did not collect everything, right? We collect only amount that's 7,000 less than amount that was sold during the year. Everybody agree? Over the year, accounts receivable increased. When you say accounts receivable increase means we did not collect everything that was sold during the year. Okay? Keep that in mind. Let me get this one out. So what is that tells you? Now, we report only the amount that we collected. So we have to increase income by 7,000. Everybody agree? That's sales, right? The sales did not record. We got to increase sales amount by 7,000 to take into that account, make it accrual. Then what else you have? Prepaid expense decreased by 5,000, which means prepaid expense we utilize the prepaid expense, right? Prepaid expense not here because they didn't pay anything in cash, but it was decreased by 5 means we utilized, we consumed maybe rent or whatever it is. So that's an expense for accrual basis accounting. So what do you have to do? You subtract that, right? That's 5,000. Decrease expense by 5,000. You subtract that. Then also you have accrued liability decreased by 4. Accrued liability decreased by 4 means what? We paid something that was from previous period, right? Accrued liability, we had, say we got 20,000 accrued liability beginning. Now it went down to 16,000. That means we paid 4,000 from previous period. So that's include in this amount, right? So you got to take it out. So this is an expense. You got to add it back, $4,000, right? Everybody agree? Everybody agree that? Okay. So decrease in prepaid, just $5,000. Decrease in prepaid. Decrease in prepaid expense. Prepaid expense decrease. Prepaid expense decrease, not the prepaid amount. So that this has to be other way. Okay. Prepaid expense decreased by 5,000. So what do you have? What is the total? 54. Get a minus 8 plus 7 minus 5 and plus 4. What's the total? 52,000, right? That's your answer. It's a little bit difficult, but go back and check why we did what we did. Okay, so you should be able to probably understand better if you go back and look at it again. Okay, we are done with the chapter 2, but it just takes time. Take time. We have another chapter 3 also for this due this week, so I'm going to do that as well, and hopefully you can all have time. You have time to go through this stuff. Okay, you had to spend a lot of time on going through this and answer those questions that put it on the blackboard. Okay.